It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast on another weekend that is dropped around Australia. Yes, it's real estate all the way with our non-stop marathon of suburb by suburb, breaking down the numbers and the trends. We are here every morning, and the weekend is nice to have. It's been a really busy week. Saturday, August the 16th, and has this week's RBA cutting of the cash rate made you more enthusiastic this morning heading out to look at property? You know, every rate adjustment does help, and it's what we are going to be talking about this morning with Anthony Landau. It was our third rate cut this year. The decision widely expected after inflation eased in the June quarter follows earlier cuts in February and May. It does bring relief to millions of mortgage holders. So good luck across this weekend, whatever you are up to, especially when it comes to property. And do let us know whether the rate cut will make a big difference in your household and how significant that is for you. And we've got this new service now. You can leave a voice message with the link below. Very, very easy, super easy. Just click on the link and start talking. Or if you'd like to send us an email, our email address is myrealestatepodcast@gmail.com. Right, let's catch up with Anthony Landau, the Managing Director and Mortgage Broker at Equilibria Finance. Good morning to you, Anthony. Yeah, first off, let's start with that cash rate. And it's been a very busy week, as I mentioned. Are all of those banks actually going to be passing on the rate cut? So lots to talk about.
Yeah, look, there's over 100 lenders, believe it or not. We've had 3 rate cuts now, and in February and May, pretty much all the lenders, bar Virgin Money and BOQ Specialist, passed on those rate cuts. Most banks at this stage, most building societies and most providers have indicated they're going to pass on the 25 basis points that was announced this week. So we've now had 75 basis points come off the cash rate. That's down from where it was at 4.35% between November 23 and January 2025.
Okay, and the other thing, of course, that we've been talking about here, 2 days ago, I was talking with Nicola Powell from Domain to talk about the latest profit and loss report for the first 6 months of this year. And these price gains, as I mentioned to her, are absolutely staggering.
It absolutely is. So it's just under 97% of houses that were sold over the first 6 months of this year resold for a profit. So it means that homeowners are walking away with money gained. A very small proportion of sales are occurring at a loss. It's roughly about 3% of sales nationally. So what it really tells us is loss-making resales in the property market are very rare. And I suspect the loss-making ones are really driven by people that are owning their home for a short period of time. You know, perhaps personal circumstances change, or they've paid over the odds when they actually bought the property. You know, we know in the property market, it's all about buying well, but it's also all about selling well too.
Yeah, and Anthony, just for numbers, if people haven't caught up with these this morning, in the first 6 months, just look at that number for Sydney in terms of how much the price gain is, $700,000. I still can't believe that number.
Yeah, it's mouthwatering, and it's essentially pricing a lot of people out of the Sydney market, particularly if they're looking for a house or moving them into units and townhouses. Nationally, the median house price has gone up $365,000 in that same period of time. Across the board, we're seeing some really, really strong price growth, which is making it challenging for a lot of people trying to get into the market.
And I mentioned this the other day, if you have bought yourself a unit in the first half of this year, units, the median price, $202,000. So everyone is a winner, as Hot Chocolate would say. How have the 3 recent rate cuts affected existing mortgage holders so far? Have you got some of the numbers, have you?
Yeah, the rubber's starting to hit the road now with the third rate cut. If you've got a loan, for example, of $600,000 since the first rate cut, and the subsequent 2, so that's 75 basis points difference, your repayments would have come down $275 a month. So that's starting to get reasonably significant. If you've got a loan of $1 million, then your repayments might have come down $500 a month since the beginning of this year. So that's really starting to have an impact on mortgage repayments across the board. An interesting thing to think about, if you keep your repayments at the same amount, which we often advise our clients to get ahead on their repayments, but if people are managing to keep their repayments at the same amount they were back in January before the first rate cut, they will be saving around $100,000 in interest over the life of the loan, which is not insignificant. Some of our clients we're talking to, we're advising, if they're able to, keep making the same repayments, have that extra money sitting in redraw, and over time you're going to save a lot of interest over the life of the loan.
We are talking to Anthony Landau on our Saturday Property Show. When we come back, we're going to talk about the flow-on effect for new borrowers and the broader housing market and the outlook for both fixed and variable rates. So we'll talk about that after this.
From the emotion of property, the economic inflation, managing your expectations, lack of stock, price growth, construction appetite, days on the market. Stay informed with us and know your property.
What we're finding and what we have found over the last 12 to 18 months is that the need for basic hygiene items, so your toothbrushes, your toothpaste, deodorant, sanitary products, shampoos and conditioners, the demand has risen so significantly that charities are struggling to keep up with demand. So we have sort of pivoted a little bit and channeled out in providing support still to the disaster affected communities, but also to people in our local community that are experiencing economic hardship. And some of the stories that we hear are really sad. So I know we still monitor our budget and we're not doing it as tough as what other families are. We're just conscious of what we spend. But if we need a new toothbrush or more toothpaste, we go and buy it. Some people are not in a financial position where they can do that. And I think my heart breaks at the idea that people can't afford the basics that they need just to maintain a standard of personal hygiene. But that has a flow-on effect on self-esteem, self-confidence, on presentation, on mental health. And that leads into further health concerns and health conditions as well. So we are trying to support as many different organisations and community pantries as we can with those essential hygiene items.
Explore new property destinations where you could live with exclusive interviews covering real estate news and market insights. You're listening to the Saturday Property Market Update.
It is a Saturday real estate morning. Lots of people heading out today to have a look at property, as I mentioned. We've got that cash reduction and all that equity capital gain. As mentioned, Sydney, $700,000. Anthony Landau is here. Anthony, what is the flow-on effect for new borrowers and the broader housing market, do you think, as a result of what's happened this week?
Yeah, there's two elements that we're seeing impacting new borrowers. There's actually the sentiment, the psychology behind borrower behaviour, which with interest rates coming down or even before they come down, just talk of them coming down, that does have its own flow-on effect of stimulating the market. We saw the last quarter of the calendar year, there was a real slowdown in the housing market, but it's really picked up in the first 6 months of this year. And a lot of that is just a pickup around inflation's coming down. A lot of it's around people expecting rates to come down and trying to get in the market before it picks up too much. So there's that element to it, but there's actually then genuinely an increase in borrowing capacity. For example, one rate cut, which we've seen at 25 basis points, a single person earning $150,000, their borrowing capacity, how much a bank will lend them, may increase by around about $20,000. So since the beginning of the year with 3 rate cuts, that might be about $50,000 to $60,000 in extra borrowing capacity. If they're a family, they're earning around $250,000. Their borrowing capacity since the beginning of the year might have gone up $80,000 to $100,000. What that's doing is that's getting people back in the market. That's getting expectations of what they're able to borrow. That's giving our clients expectations of what they're able to borrow, more ability to get into the market. Flow-on effect of that is it stimulates demand. Potential flow-on effect from that is that it actually has the impact of increasing prices. And there's some data out there saying that, look, we've been growing at around about 4%. That might pick up to around about 6% by the end of the year, with these rates coming down and more demand coming into the market, with supply still being fairly limited.
Yeah, that borrowing capacity, it affects people in all sorts of different ways. Some people might have been just on the outer saying, well, we just can't quite get into the real estate market in 2025. Now with this latest drop, and as you've highlighted, it will push people over that barrier of resistance. They will be able to engage with mortgage brokers like yourself, and suddenly, who knows, by the end of 2025, if that is you, you might be able to get into a property. Then it also leads into whether or not to fix the rate or go on to a variable rate. This is the million-dollar question. It gets thrown around all the time. And you'd like to sort of break that down, make it a little bit more plain English for people this morning.
Yeah, look, generally speaking, when rates are going down, not a lot of people fix. We're not seeing a lot of existing or new mortgage holders look at fixing their rates at the moment. In saying that, there are some fixed rates now just creeping under 5% over the 1, 2 and 3 year terms. However, with expectation of further rate cuts, a lot of people are just sitting and waiting, maybe till the November board meeting, just to see what happens next. So the fixed rates are sitting maybe 1 or 2 rate cuts below where the variable rates are sitting. Not a lot of people are fixing at the moment with that expectation of further rate cuts. What we are seeing on the variable rates is a lot of competition by providers. There's a lot of good opportunities for new borrowers. We're securing a lot of good additional discounts from the major banks and from the second-tier providers looking to attract new business. So there's some really good, healthy competition amongst the providers for new business. And in terms of if you are an existing mortgage holder and your mortgage broker or you yourself haven't spoken to your bank and asked for an extra 5 or 10 basis points off your home loan rate, in addition to the recent rate cuts, then you should do that, because the banks are really focusing on retaining their existing customers and looking after them. So we've been securing some really good additional rate cuts on top of what the RBA's been delivering for existing clients as well in that variable space. So some good, healthy competition at the moment. Not a lot of people fixing, but I think after November, December, we'll get a better picture on where the fixed rates are going to go over the next 2 or 3 year period.
All right, Anthony Landau, we will leave it there for our Saturday morning. Yes, we do have to wait a little longer for the next rate cut, and hopefully that is coming in November. Enjoy your weekend and look forward to chatting again soon.
Have a great weekend and we'll catch up soon.
Decode the property market with insider knowledge and insights to better navigate your real estate journey.
The most in-demand suburbs for buyers across Australia, which includes Forestdale, Rocklear, Goodna, Loganlea, Mount Gravatt, Spring Hill and Slacks Creek. So perhaps first off, just give us a little bit of a breakdown on where Goodna is and what makes this an attractive area to buy into.
Yeah, so Goodna is located 25 to 30 minutes out from Brisbane CBD. It's one of those suburbs that were, is a very quiet suburb. Demographic has started to change, hence why we're seeing the growth in the area. Properties in Goodna during the COVID period, it was still very slow. We weren't seeing that boom that everywhere else was seeing. Goodna was the last to come up. It's one of those areas that we're seeing a lot of people from the north side of Brisbane come in, Brisbane CBD. They can't afford necessarily out those ways.
We connect you to the best real estate information across Australia. The Real Estate Podcast.